Hello everyone, welcome to the channel of Tradeometry. Today is Thursday, April 9th. We have a lot of things going on in the past few days, and yesterday we all saw Trump announced the temporary ceasefire deal. Basically we'll get 2 weeks of ceasefire, and in the meantime US and Iran will discuss a permanent end of war. That's per the initial news release. And then there were some very weird things start to come out. There's the Iran version of the deal, and there's the US version of the deal. And then there's confusion regarding which deal Trump agreed to. And then Israel appeared to be continuing bombing Hezbollah, and Iran said the ceasefire would stop if Israel continued to strike Hezbollah. And then Israel saying the Hezbollah was never part of the deal. They're saying they'll continue striking Hezbollah. And then it's just going back and forth non-stop the whole day. And then as of right now, I think there's only a few ships passed through Strait of Hormuz since the ceasefire deal. And then you can actually see the oil prices start to rebound. It went to over 102, then it came back down, and then now it's back to 98. It's a lot of back and forth. And then it's very, very interesting that the general market doesn't seem to be bothered. And to me, that's very, very suspicious. You see S&P 500 continue to edge up a little bit. If the market actually wants to make a reversal, it needs to match the time frame, which has not been satisfied just yet. What do I mean by that? So you see when S&P 500 went from this huge distribution box all the way sell down to this 630 and below, this much of selling pressure doesn't just go away by just a few green candles like that. Usually, in my personal experience, it takes at least similar amount of time to fully consolidate all the selling pressure and people buying back in the corresponding box below, and then you start to reverse. A reversal like this usually won't hold up because it's just not enough time for buyers to accumulate down below right here. There's only like 1 week in this purple box, but right here you almost have like 7-8 weeks of selling, which is not going to be enough in my opinion. So, and this makes me more suspicious, and it feels like a dead cat bounce instead of a solid reversal. And I think this current bounce is primarily driven by the CTA and the FOMO buying triggered by algo. CTA stands for Commodity Trading Advisor. It is a systematic and mechanical trading strategy implemented by various institutions. They have certain price levels to watch on S&P 500. When S&P 500 breaks above a key resistance, they'll be buying. And when S&P 500 breaking below key support, they will be selling. So kind of like a momentum trader. And the CTAs were net short before yesterday. So the huge rally yesterday basically forcing CTAs to short covering because it triggered a major level. And also the ceasefire news definitely triggered a lot of algo FOMO buying as well. These two factors mainly contributed to this current short squeeze. But I do believe both of them will end up being the back holder here for a few reasons. So if you can see, S&P 500 is already recovering to the end of February level, which is before the war started. However, the oil price is still 40% higher than before the war started, which I think the market is overly optimistic. And Israel, as of right now, is clearly not honoring the ceasefire deal. Iran only allowed a few ships to pass through the Strait of Hormuz since the ceasefire deal. And tomorrow we will have the March CPI data point, which I think is going to be really, really bad. If you remember what happened in March, is the entire breakout of the war, and oil price spiked 40% during this time. So March we were around at 80, and now we are at 125. That's almost like a 50% jump from end of February. And then the JPM caller option basically capped the upside of S&P 500 in Q2 at 6,865. So that's typically the upside. If you don't know what JPM caller is a large-scale quarterly option strategy used by JP Morgan hedged equity fund to protect its portfolio from significant downturns while capping potential gains by selling out-of-money calls to fund the purchase of out-of-money put spread. The strategy creates a hedged range for S&P 500 exposure. So if you're interested in the details, you can just Google it for yourself. And from my experience, these JPM caller are usually pretty accurate. And the short call price right now is at 6,800, which we're already right here. If I draw a line, 68, 65 would be right around here. So the upside is very little from here. There's like maybe 0.5% from the current level. So from the risk reward perspective, I think this is a very good setup for a short play. And another big factor I'm watching is the software. Software is getting killed today. I know we're seeing a lot of new product release from Anthropic and OpenAI and all that. Do all the software companies getting completely wiped out because of these new AI innovations? I don't think so. The market is apparently panic selling all the software, regardless what it is. You look at Palantir's down 8% today, which is really, really rare. After being down 7% yesterday, down another 8% today, and we still have a 1 hour left. And then you look at the other ones like CRM, down 3%, ServiceNow down 8%, another 1 year low, and then the Intuit very close to 1 year low, and Adobe 1 year low. And even you start to look at some of the network security stocks like CrowdStrike, down 8%, Cloudflare down almost 10%, Palo Alto Network down 4%. All these software companies are getting sold regardless of what the business is. All the institutions are dumping all the software companies right now and ask questions later. I think this is also part of the private credit crisis getting worse. The usual suspect, all the software, and then you look at the Oracle as well. All the companies related slightly to private credit is getting sold. So even though I do have some long stock options, but I'm added a lot of put to protect my position starting from yesterday, and I added more today because I think this current gap is too big to not get filled, basically. Even though we're seeing another green day, and S&P 500 seems to be breaking out to an extent, but I don't really believe this breakout right now, simply because we don't have enough time consolidation down below, and also because we're vastly underestimating the current risk that we are facing. And that's all for today, and I'll make another video over the weekend to update my P&L. If you have any questions, please leave the comment section below, and I'll see you next time. Bye.
Another Monday, green on the screen, feeling so serene. Leverage the assets, living the dream, a money machine. Blue chip vision, make the right decision with perfect precision. Yo, we own the street, can't accept defeat. This bull run is sweet.